Welcome back to Insights Now. I'm Brendan Hall, research analyst here at JP Morgan Asset Management, and I am excited to be interviewing David for today's episode. Deficit spending is not at all a new phenomenon in the United States. In fact, it is the norm, and the U.S. has run a budget deficit in 81 of the last 95 years, or 85% of the time since 1929. What is abnormal, however, is how large the pile of U.S. debt has grown relative to the broader economy. In fiscal year 2023, U.S. debt held by the public ballooned to $26.3 trillion, or striking 97% of GDP, while the budget deficit rose to 6.2% of GDP. And projections from the Congressional Budget Office suggest that the debt dilemma may only get worse in the coming years. With the election quickly approaching and last year's debt ceiling and downgrade drama still fresh in investors' minds, we often get asked, how will rising federal debt impact the markets and the economy? To help us dive deeper into this question, I'm excited to be joined by the usual host of the show, Dr. David Kelly, Chief Global Strategist for JP Morgan Asset Management. Now let's get started. David, welcome to the guest seat on Insights Now. So David, as I alluded to earlier, debt held by the public as a percent of GDP is sitting near 100%, which is really unprecedented outside of war times. So what has caused the rapid increase in federal debt in recent years?
Well, this has been going on for a while. Believe it or not, back in the year 2000, the federal government ran a surplus, and the debt to GDP ratio was around 36%. So what's happened since then? 2 wars, 2 recessions, big recessions, and 2 tax cuts. First of all, after 9/11, we had obviously the war in Afghanistan and the war in Iraq soon after that. And that cost a lot of money added to the debt. Second, if you go back to 2000, in 2001, we had a series of tax cuts which weren't funded at the time. And so they did add to the debt and the deficit. Now, at the time, our debt was fairly low. But then if you move forward also to 2017, we had a second round of tax cuts, the Tax Cut and Jobs Act of 2017. That also was not funded. And so that sort of put a structural deficit in there. And then on top of that, we had 2 recessions and the federal government responds to it. So the great financial crisis, first of all, it kills the economy, that kills tax revenues, but also we do a lot of government spending to try and get us out of it. And then in the pandemic, even more so. We had a relatively short recession, but the government poured money into the economy to deal with, to fight COVID to some extent, but largely to try and maintain living standards. And that just that added a lot of actual debt. But I would say, I think over time that's what's added to those are the things that have added to the debt. The reason we still have a significant deficit today, which is, and the accumulation of all these deficits gets you to the debt, is really twofold. One, we now have more normal interest rates. And so right now we're running a deficit of close to $2 trillion. And about half of that is just interest payments because we've got normal interest rates on, which, as you say, is 100% of GDP. And the other thing is that these tax cuts that we've had over time, along with the aging of the population, the growth in Medicare and Medicaid, and particularly and also in Social Security, they are building in a structural deficit. So there's a structural deficit because we haven't made a lot of choices over the years, as well as the interest cost right now. And that's why we've got the deficit, and that's why the debt is still rising.
Thank you. And I'm curious to hear your outlook moving forward. So both in terms of the deficit and federal debt, what do you expect moving forward, and will the outcome of the November election change your opinion?
Well, the deficits are going to stay pretty stable as a percent of GDP, but at a very high level. We're looking at deficits which will soon exceed $2 trillion per year and really continue to climb slowly from a $2 trillion a year point. Now, what that amounts to is about 6% of GDP, so that is significant. The debt, because you've got running these deficits every year, the debt is going from about 100% of GDP. I think it's going to be about 99% of GDP for this fiscal year. It's going to rise to about 124% of GDP, according to the Congressional Budget Office, if we don't extend any of the expiring tax cuts from the Tax Cut and Jobs Act. If we extend all of them, then the debt is going to go up to about 134% of GDP. So it's going to be significantly higher if we extend any of these tax cuts. And I expect that whoever wins in November, most of these tax cuts will be extended. I think if the Republicans sweep, particularly if they sweep with in a landslide, I think all of the tax cuts will be extended. But if the Democrats sweep, I think that most of these tax cuts will be extended. So either way, I think by 10 years out, we're going to be looking at a debt to GDP ratio of over 130%.
Wow, so quite impressive and quite unprecedented. Mm-hmm. If we go back to our Economics 101 classes, in theory, fiscal deficit should help boost economic activity. But given that the U.S. is already running elevated deficits and is already heavily indebted, do you think that this will be the case over the next 5 to 10 years?
No, I don't think it's going to be, at least in the short run, I don't think it's going to help the economy grow faster. It's not just the level of the debt and the deficits. Now, I will say this, that it is the change in the deficit, not the deficit itself, that spurs economic growth. So you're running a deficit of 6% of GDP, you cut that to 4% of GDP, guess what? You're slowing the economy down. You raise it to 8% of GDP, you're speeding the economy up. But the real problem right now, it's not really a problem, is that we're at full employment. We've only got a 4% unemployment rate roughly, and we are seeing some growth in the labour force, but really we don't have that many more workers. So if you put extra demand into the economy, like we did with all that pandemic aid under both the Trump administration and the Biden administration, you put a whole pile of extra demand in the economy in the form of federal deficit, you're just going to get more inflation because you can't produce more output. So I think that deficits can stimulate more economic growth and without stimulating inflation when you've got unemployment, significant unemployment. But when you're at full employment, it doesn't really help speed up the economy.
Thank you. I think that makes a lot of sense. And that was a great overview of the economic impacts. But let's switch to the market impact. Mm-hmm. So as the U.S. government continues to borrow to finance its spending, how do you think markets will react?
Well, I think there are two things to be said. The first is I'm not terrified that we're going to end up with some financial meltdown here. Now, I do expect that the debt will gradually rise into the 130% of GDP range. But what we do know from the last few years, in fact, particularly from last year, is the federal government ran a huge deficit. The Federal Reserve, it was about $1.7 trillion. The Federal Reserve was selling treasuries back into the market or allowing them to mature to the tune of about $700 billion. And the Treasury Department itself was building up a stockpile of cash in its checking account at the Federal Reserve. So overall, all told, the federal government borrowed more than $2.5 trillion last year. And it succeeded in doing that with the 10-year Treasury yield ending the year at exactly the same rate as at the start of the year. And that tells me that the world has got tremendous demand for U.S. Treasury debt. We have a problem with it, but if you're a global investor and you're wondering, do I buy U.S. Treasury debt? Do I buy Chinese debt? Do I buy European debt? Do I buy Argentinian debt? U.S. debt still seems like the safest, most liquid form of Treasury debt. And we've got a global population that is trying to plan for retirement, build assets for retirement. So that means there's a lot of demand out there. Now, that's the good news. I don't think that in the short run it's going to cause a crisis. And if it did cause an economic crisis, then the Federal Reserve could, of course, go from quantitative tightening to quantitative easing again, and that also should take some of the pressure off interest rates. But I do think the fact that we're going to have to borrow this amount of money every year, increasing over time, puts a limit on how far long-term interest rates could fall. As we're recording this right now, the 10-year Treasury yield is about 4.1%. Historically, in the 50 years before the financial crisis, the 10-year Treasury yield was 2.7% above the core CPI inflation rate. So that would suggest a 4.7% rate. So 4.1 is actually already a little on the low side. Do I think it's going to rally a lot in a recession? It might initially rally, but I think there's a limit to how much long-term rates can fall because the government's borrowing so much. And so I do think it has an impact there. I think that people should have bonds in a portfolio to diversify, and it will to some extent bonds will to some extent zig as stocks zag, but I don't think you're going to see a big rally in the bond market even in a recession because there's just so much debt to be financed.
Thank you. And you kind of alluded to your answer of my next question in that previous response, but maybe diving a little bit deeper, what do you think are the risks, both near-term and long-term, of rising federal debt? And how can investors prepare their portfolios for those risks?
Well, of course, the risk is that the scenario I'm outlining here, where we get to a debt to GDP ratio of somewhere in the 130 to 135% range in the next decade, assumes that there isn't another huge war or another huge recession. If that occurs, then we're going to be in a worse situation. So one of the risks is that we get hit by one of those shocks which seem to occur too regularly in this century. And that just makes the situation much more difficult. A second risk is the issue with debt and the economy and stability has a lot to do with inflation. And because ultimately the issue is not how much debt can you hold, but how much debt can you service. So long as interest rates are low, then the government can service a lot of debt. I mean, the Japanese government's got a debt to GDP ratio of 200% or more than 200%. It doesn't seem to cause huge interest rates there, but they don't have a significant inflation problem. So if inflation picks up, then we would have a much more significant problem because long-term interest rates would get pushed up by higher inflation. Now, what could push inflation up? Oddly enough, if you try to reduce inequality, if you raise taxes on the rich but cut taxes on the poor, gave subsidies to the poor, suddenly got more demand for goods and services, then you start getting some inflation. That inflation puts up long-term interest rates, and then you've got a problem. So that's another sort of possibility in terms of what would go wrong here. I suppose one other issue is we are borrowing a certain amount of money from the rest of the world. Suppose the rest of the world decides they don't feel safe or don't want to lend it to us anymore for political reasons or for whatever reason. That could hurt also. And then finally, one of the things that Milton Friedman used to say about the debt and the deficit, which I thought was very wise, is in some ways the problem isn't just that you've got government deficits. It's that government deficits are allowing the government to do a lot of things that the private sector ought to be doing. And so one of the dangers is that you use too much fiscal policy to try and achieve certain macroeconomic aims when really what you should be doing is just allowing the private sector to do its thing. And so that's also one of those dangers in allowing deficits to be very large and grow for a long time.
And do you have any specific way in which you think investors should prepare for that?
So I think there are two or three lessons from this. One of them is, as I said earlier, the amount of borrowing means that bonds cannot be the only diversifier in a portfolio, because you could get hit by inflation, in which case bonds aren't much help anyway. But even in a recession, you're not going to get much of a rally. So if your stocks zig very badly, your bonds might only zag a little, and you're still in trouble. So that argues for very, very broad diversification. I think because this is a sovereign debt problem, one possibility is investing in the government bonds or other securities of countries which, whatever else they have wrong with them, are not as reckless when it comes to government finances. And, obvious countries are countries like Switzerland or Norway or Germany, where they're much more careful about their government finances. And then also, just diversify through alternatives and international investments in general. But alternatives, can fill a lot of the gaps in a portfolio and give you that diversification, which bonds may not give you if there's if we do have rising debt and conceivably rising interest rates in the long run.
Got it. David, that's all the questions I had for you, so thank you so much for joining me today, and I appreciate your time.
Anytime.
On the final episode of this season of Insights Now, join David for a discussion on the upcoming U.S. election and how it might impact investors. To all of our viewers and listeners, thank you for tuning in today, and speak with you soon.